Morning, everybody. And you may notice I've got a little nasally voice today.
Better than no voice.
Yes. And just so everybody knows, we are recording. We got some feedback that people want to continue to do these live versus recording, so people have an opportunity to ask questions. So we'll keep doing that, and we'll keep recording them for the folks that don't want or can't make it to the live sessions. Today, I'm going to be kind of brief because I do have a voice that's teetering on the edge. I was sick over the weekend, so I will spare it as much as I can. We'll give a few more minutes until we see everybody arrive. So we're going to stick to pretty much the traditional agenda. There's a few items just thrown in there that might be a little bit different. The market, treasuries, the economy, the Fed, net investments, and then our takeaway. And we'll revisit kind of the main theme that we've had about the five major factors in the economy, including tariffs and those kinds of things. So we'll talk about that. So the S&P 500 continues to go up above 6,000. Again, I do think this is a false market. If you look at the valuations in stocks, they continue to be ridiculous. And Warren Buffett, for one, is not buying it. He is not getting into the market. He might buy a position here or there, but he primarily has cash on the sidelines. So I tend to follow what he thinks is going on. So the treasuries, you'll see the yields have continued to rise. Now, there's a lot of factors for this. One is that treasuries, our biggest purchaser of treasuries or US debt is China. And there's been some tension with China on trades and tariff and all of that. And there's been a concern that China would dump our treasuries on the open market, which would drive the prices down and yields through the roof. Just today, we learned that a deal with China is put together, at least the structure of it at this point, and they have 90 days to complete it. It's a much more tame deal than what was initially discussed. The tariffs are positive for the US. There's some trade specific deals on minerals and things like that that are positive for the US. So, all in all, I think it will be a positive deal. And I think the market has seen it as such today. So, I think what we'll see is those treasuries, the yields will start to come down, which means the values are going up. So that'll start happening, I believe, from this point forward. I think we've hit a peak on those interest rates, on those yields. So expect to see that start to happen. US payrolls increased by 139,000. So more than expected. This has been a recurring theme over the last several months. The expectations put out by economists are that jobs will slow down. And actually what we're seeing is they're speeding up. So we continue to add jobs. And what's different from the jobs numbers now versus, say, a year ago or even 4 years ago is the majority of the jobs that are being added are not government jobs. Whereas in the past 4 years, the majority of the jobs were federal government jobs. So as we're seeing people transition out of government, we're seeing those normal jobs start to increase. So two things on this inflation. So inflation rate slipped to 2.1% in April, lower than expected. Today, we got another reading where inflation rates were expected to rise, and we actually saw them decline to the point that we've seen the lowest year over year inflation number since 2020. Like I said, my voice is going quick, little T. So one of the big discussion points with these tariffs has been that it's going to create increased inflation. And what we've actually seen is a decrease in inflation. That's not to say that we won't see that going forward, that we won't see a tick up in inflation. So the Fedometer continues to stay in the same place. We should see more aggressive Fed policy coming. The entire world has cut their interest rates. The US has not. So we probably, for a number of factors, need to see that happen pretty soon. So trueflation, this is the inflation number based on all the different factors, not just where the government cuts out specific items or weighs other things heavier. We're at 1.93%. That's actually higher than we were last month. You'll see we got down as low as 1.22% on inflation. 1.93 is well below historical averages and below the number that the government is using, which is 2.1. We're really in a good place with inflation as it stands now. Okay, gold again continues to rise. So we're up over the last 12 months. Gold, of course, is a hedge against the market dropping. It's a hedge against inflation. Despite the market going up and despite inflation going down, we still see gold continue to move up. Silver, same thing, not to the same extent over that same period. Okay, so we talked about the 5 areas to fix in the economy. It's not all about the tariffs. So the big bad tariffs, when they were originally discussed, we talked about how the news articles, about 50% of the economists were coming out and saying they're going to be horrible. It's going to cause inflation through the roof. Well, we've seen that's not happening. Knock on wood so far. What it's doing is getting countries and companies to the table to negotiate. And so we've seen a very steady increase of that happen. Tax cuts. So right now, as it stands, if the bill that's with the Senate does not pass, we're going to see the largest increase in tax billing in history before the end of this year. And the bill actually keeps that from happening. So it would keep tax rates the same in many situations. It would add some tax cuts for tips and overtime and things like that. So this bill would be a huge for the everyday taxpayer, just at the very least to keep them in the same place. It is not a perfect bill. There are a lot of things that are, like with any bill, are what we call pork, things added in there that don't benefit citizens. They really benefit the friends of politicians. So in that way, it's not the best bill, but it's step one in reducing the net cost to taxpayers. So that needs to go through, or some variation of that needs to go through fairly soon. The goal is to have it done before the 4th of July holiday, and that would give everybody a tax break going forward. Deregulation, we're seeing this across the board where, for example, all of the folks that want to bring manufacturing back to the US, the retooling of factories, the building of new factories, the deregulation of that is allowing things to move much faster and allowing investment in the US to come in much faster. So, very important piece. The reduction of wasteful spending. There's, as I've said before, you can cut with a scalpel, you can cut with an axe. Right now, they're cutting with an axe. They're going in there and they're cutting. If 85% of this spending is wasteful or useless spending, they'll chop that department off, and then they go back and add back in the pieces that are actually helpful and useful. In that way, it is inconvenient for a lot of people. In the end, I think they'll get a good balance of where things need to be. But that doesn't mean there won't be pain and struggle in that area. That being said, we have 36 to 38 trillion in debt because we refuse to manage the spending. So we need to go in and fix it. And finally, interest rates and Fed policy. So as I've mentioned before, there's two levers for managing interest rates. One is if the stock market drops, people flood to safety, which would drive treasury bonds up in value and their yields down. Trump doesn't want to pull that lever, but he will if he has to. And then the second is Fed policy and the Fed reducing interest rates. Jerome Powell is fighting it tooth and nail. It really seems like a political statement more than an economic statement at this point. The US has 8 trillion, I believe, in treasuries that mature this year and some very soon. And they're going to be refinanced at a rate that would continue to create interest debt versus paying off some of the debt that we have. And so it's really important that we get these interest rates lower as these treasuries refinance. So just today, Trump suggested that we have a 1% Fed cut specifically to lower the interest on these treasuries. So right now we're paying over $1 trillion in interest a year just on our treasury bonds. If we can get interest rates lower, we could see that a savings of anywhere from 200 to 400 billion in interest. To give you an idea, I think it was determined that 160 billion would remove the poverty issue in the US for the entire country. So if we could save 200 to 400 billion a year in interest alone, that would be a huge boon to the economy, to paying off our debts, to cleaning up the balance sheet. So all 5 of those things are really important to have happen going forward. So the big takeaways are we're just going to keep on the same path. Hedge assets seem to be doing very well, not just the traditional ones. Any questions?
So do you think the Feds are playing a wait and see game to see the impact of tariffs and agreements?
I think in part. So for example, the Fed suggested that their target for inflation, I believe, was 2.6% and below. And so we've solidly been below that for a period of time. And we're actually seeing inflation go down and not up. So I think if nothing else, this last announcement this morning should give a little bit of pressure to the Fed to start cutting interest rates, that inflation is not the risk that it's being portrayed to be, at least at this point.
And this bill, the big, beautiful bill, that's allegedly supposed to raise deficit by 3 trillion. Is this the case or?
Well, I don't know. I don't know exactly how that works. So if you look at different independent economic groups, they'll look at just tax revenue and things like that. So absolutely, it will reduce the tax revenue that's coming in. But what they don't account for is the reduction of spending. So as we're seeing cuts in other areas, those offset the reduction in tax revenue. So it's a guess at best at what the eventual result is going to be. They're just looking at what's on the books now.
Mm-hmm.
So if everything that's being talked about, all the 5 things that I just discussed continue to happen, the bill will be a net positive for the economy. If everything stays as is, it would be a net negative because tax revenue would be lower. So a fairly simple answer to a very complex question.
Yeah, it'll help the 2 people that pay taxes on their tips.
Yeah, exactly.
Thank you. That was a very good assessment. Thank you.
Matt, also on the topic of the tax bill, it makes permanent some of the tax cuts that were enacted during Trump's first term, right?
Correct. That's the big increase of taxes that's coming if it doesn't lengthen that.
Got it. And so I felt like tax cuts during the first administration were actually a big tax increase for me because of the mortgage write-off.
Exactly.
And so if this bill doesn't pass and it completely crashes and burns, does that mean that I'm getting the tax break that I used to get? Which would
That's
honestly,
a great question. So I experienced the same thing as you with the mortgage deduction, where I lost some of that. The simple answer is I don't know. I don't know because we've had California state laws change over that time. I'll have to look into that. Yeah, that's a great question.